Hi, everyone. Welcome to the Seattle Angel Conference Workshop Series. We're talking about due diligence today, but we're going to focus a little bit on what we're doing with the investor point of view. And so that investor point of view is focused on the question of I am a investor. I have just heard a bunch of information from a startup. Now, what is it that I'm going to do? And so, let me introduce David here a little bit so that everybody knows what David is doing. David,
Yeah, I'm David Busby. I am going to be deal lead for SAC number 30, which involves doing the negotiation once we have selected the company from SAC that is going to get the investment.
yeah, cool. And I'm John Seacrest, and I run the Seattle Angel Conference, and we've been doing it since 2012. We do it twice a year, and we're coming up on Seattle Angel Conference 30. And in our process, we do a bunch of pitches, which Josh in our previous conversation was focused on this question of um, how do I get through the experience of the Angel Conference and get there. So we're doing pitches to get people from the wider audience down to the ones we care about enough to do due diligence on. But what are we doing with due diligence? So David, you've been in both sides of that equation, watching due diligence happen as the founder and then doing it as an investor. So, what kinds of things are you trying to do when you do the due diligence?
Uh, from the founder side, was trying to convince a group of people that I was the right person to give us the money.
Yes,
Um,
of course.
and and I don't know if this recording is not going to have the context from the previous one with Josh doing his presentation, but there was on that side putting all of the good information about the company. Our marketing materials are in there. If we had good marketing materials, our financials were in there. Uh, our employment agreements, what we had laid out with the employee stock option plans were in there. Here's a letter from our legal counsel that says our company is properly organized and reasonably well represented. And from the diligence side, as the investor, there was a lot of digging through what's in the data room, and then there's a whole bunch more that we do. The diligence room, your data room, excuse me, will have something in there that says we have these LOIs with some other company. So it's not uncommon that the investor would say, "Oh, you have an LOI with Unilever. Can we talk to somebody at Unilever and back that up? We believe you. I believe you. Just show me." Right? And oh, here's your financial projections. This looks okay. Here's your statement from your where you say you have your cash on hand. Could you just show us a bank statement? Here's
So,
a
so I go back to the Reagan era statement, trust but verify, right? So over the
no. I don't
last
do that
six,
one. I do what my grandmother told me.
uh,
She's from Missouri. I believe you. Just
show
show
me.
me.
Yeah, yeah.
And
So
sure,
the
Reagan, but I don't think
Yeah, so we spent 6 weeks going through looking at a whole bunch of companies, and then they said a whole bunch of things. And the first level of due diligence is to take all of those things and get some level of third party validation that what they said was actually what they've got. And a lot of times, sadly, um, startups don't always go back and update their documents. And so what they gave us was not what was the current state. And so there's a certain amount of just getting everything updated along the way. But what kinds of things, when you were on a due diligence team the last time in SAC, um, what kinds of things were you pushing on?
uh, proving out that they'd done their research on their customers.
Okay.
I mean, one thing to be clear about is through the whole part of the pitch cycle before you get to due diligence, there's sort of this expectation that everything the entrepreneur is saying, everything the founder is saying is true. It's like, why would it be not true? But once you get in there, you need to see, I guess, how true it really is. If they say that their market size is so big, what research did you do that says your market size is actually that big? What have you done to, what kind of primary research have you done to demonstrate that your market size, your SOM is actually that large? Is that you read, you had an AI summary from a Google search that said that there's 130,000 CPAs in the in the Northeast, and they need to buy your services. That's not good research, and that would come out in diligence. Like, how many phone calls have you made? What's your own spreadsheet of your primary research look like? Same story with the numbers. Do your unit economics pan out? If you have something that's very technical or requires a lot of hard science, you should expect that your diligence process is going to get a bunch of pushback on something like that. Again, I think with SAC, we spend a lot of time specifically focusing on, is the business good, with the assumption that all of the technical problems will totally work, without it being an insurmountable technology burden. But if you spend a lot of time talking about that technology, you can expect a lot of time with the diligence team pressing on that factor.
What
Sometimes
kinds of
that's
things
easier to pay attention to than the business part.
what kinds of things do you think? Yeah, we separate, is this a good business from is this a good deal? And we're focused very much on business fundamentals in the core of the due diligence. The is it a good deal is what the due diligence lead, sorry, the SPB lead, which you are going to be for SAC 30, will spend time doing that conversation in a separate conversation. But when we're focusing on is it a good business, what kinds of things did you see in our due diligence reports that sort of raised a flag for you of saying, nah, this isn't going to be interesting as a good business?
There was there was one company that came through that had a very small market, and they had a very small margin, and that just did not look like it was going to become a business that was going to scale up very large, and we were looking for something like that, and that was discovered in the diligence part. Megan, you have your hand up, and I know it's
Yeah.
good.
Oh, thanks. Well, I was just going to say, in the last due diligence that I did, the entrepreneur stated that they had a strong partnership with a first customer, that they already saw the data from their output, they saw value in the data. And then I actually did the customer interview with the who they referenced, and they said they actually hadn't received any data yet. So that's an example of, not just trusting the entrepreneur, right? Trust but verify, right? So that was my example.
I mean,
So a lot of times startups essentially oversell, right? They're telling you a lot of things that they hope to be true, but the reality hasn't quite caught up with their hope yet. And so when that's done a little bit, then okay, they're a little enthusiastic. When that's done a lot, that feels like fraud, and it doesn't take much for the investor mind to flop over to, okay, this guy's a shyster, and we're out of here. And then everything's done from the due diligence team point of view. Are there other things that came up for you guys along the way?
well, John, you guys both bring up a very good point. There's a lot of stuff that is happening in the early part of the company that is your plan for future awesomeness. And if you talk about your plan for future awesomeness as that is our plan for being awesome in the future, it's easy for somebody to understand that and use that as the reference point for the claims that you are making. This customer hasn't seen the data, but they're going to see the data in 3 weeks, and we are certain they are going to love it, and we're going to tease them with something in 1 week. There's no BS involved right there. The customer has already seen the data and they love it, but they haven't when you verify. That's BS, and that's a big problem. There was a friend of mine was a financial advisor and would try to talk to people about their money, and people would talk about their own money and they wouldn't tell him the actual number. And then sometimes they would want to say that they had a bigger number than what they actually had. You can't get good financial advice from a financial advisor if you tell them that you have $10 million, but you have only $2 million. You will get the wrong advice. The same thing is true about your startup business. If you are the founder that's in there and saying, I know I'm going to have $10 million in the future, but you only have two right now, you need to say that you have two right now and a plan to get to 10 so that you can represent yourself correctly and truthfully on the way through, because it will come out in that diligence process. One of my first experience with SAC, the company came through and the person who was doing their presentation the whole time wasn't the founder of the company. He was the CEO, but he was not the founder of the company. He didn't come up with the technology. He kind of knew nothing about the technology. And through that whole diligence process, we asked the question probably 9 times, how come this guy is in the big chair when he didn't invent the product? And how come his compensation looks very, very big, as a big portion of the company? Well, because we discovered that the founder is way too med tech, doctorate level engineering to be able to run a company. And the person who's sitting in the big chair doesn't know very much about the science, but knows a whole lot about running the company. And you know, at a first glance, it looks like, well, how come the person who came up with it isn't in charge? And then you look at it the second time and go, oh, the person who came up with it was smart enough to know what they didn't know and put the right person in the big chair. That's the kind of stuff that you discover, and also discover a lot of the why does the company look this way through that process.
So when we do the selection, we pick 6 finalists. And then with those 6 finalists, we form due diligence teams and ask the due diligence teams to ask the companies for specific things for the next meeting where we're going to sort of start the conversation about due diligence. What kinds of things were you asking for when you went through that process? So let's go with Megan.
Well, the biggest insight that we got was in their financial documents, because they didn't really have any, which just
What
showed a
what
huge,
do you mean by financial documents, if we could be precise?
oh, profit and loss, right? Bank statements, like David was saying, where their money is going, what's input and output, basically.
Yeah.
And so we saw that they did have some funding, but there was an exorbitant amount going to the CTO each month. And we asked for some, monthly statements, and couldn't get it. And I think that it takes a lot of discipline to run a business, right? You're essentially running a small country. You have GDP, you have infrastructure, you have, culture, you have a lot of different aspects to a business. And a lot of entrepreneurs just focus on one or two aspects, and forget to have discipline across all of it. Um, the organization too is pretty eye-opening when you ask for, finances, go-to-market plan, milestones. A lot of the milestones that we receive are aspirational. And then when we ask for exactly how they're going to carry through those milestones, we just get, well, we're going to get funding and we're going to hire someone. But to me, that's who are you going to hire? What is their plan, right? We need more detail than a lot of times we get. So that's
But
pretty eye-opening.
it's always surprising to me when you say, I'd like to see a profit and loss and a cap table, and then they say, oh, and then they scramble for a couple of weeks to put it
Yeah,
together because they don't have it. So
exactly.
we say we'd like to see your cash flow, and we really mean 3 things by that, and I want to get explicit, right? We mean a cash flow backwards of what have you been spending your money on. We mean a cash flow projection for the next N years, where is it that you're going in the long run, and help convince us that you're going to be scalable. And then David put in this notion of a 13-week projection, or that's your basic cash flow management discipline of how the money is going to be spent in the next quarter, right? And so all three of those are documents that we should see in your financials. Yes?
Yes,
How
and
how many of the companies that have come through our program have presented you with all three?
zero.
Yeah, okay.
Oh, I've seen more than one, but also it's the ones that were able to present it. If you have reasonably good finance stuff set up, all of the documents that people are asking for are 2 or 3 clicks away. Or you have to go to Wells Fargo. So you sign into your bank and then you have to find that little key fob that has the little weird passcode so that you can sign in. It's not like it's a terrible burden. It's not each document is, let's say, a 15-minute task. So those 4 documents, that's an hour's worth of work. You should be able to get it done while watching an episode of like Law and Order
Yeah,
and
there you
Well,
go.
ship the stuff.
and I will say, I mean, I have zero financial background, but that's why there's YouTube, you guys. Like, let's just, go online and do some research. What does it take, right? What does a P&L look like? What is a cap table? Just go and do some basic research on the different aspects of business that you're going to have to present because you will be asked it. And it's really not that hard to just search and there's so many resources out there.
But on the other hand, a lot of times people are not tracking their business. We're pre-revenue. Why do I need to have a bookkeeper? Or we're just not that form. But yet, if you have your financial discipline in place, everything starts flowing and you're sort of on top of your data.
I
But
mean, that's that exercise. The diligence team is looking to see that you are doing the exercise. I'm not an
right.
Olympic swimmer. Why do I need to practice treading water? Because I want to become an Olympic swimmer. So I need to do the practice right now, especially when it's easy, because the numbers are smaller. You can count all of your money on your fingers, much, much easier than when your company has 18 or 30 employees and different divisions, and then you have to switch over from a cash basis to an accrual basis. What does that even mean? You need to be ready for that, and you need that exercise to be ready for that. Yeah.
So not only are we caring about the financial side, we're caring about the sales side, right? Where is the marketing happening? How does the content strategy work? How does the sales go from uh, unaware to totally excited and producing referrals without having to work for it? What kinds of things are you looking for on that side?
uh, I'll jump on that one first, if you don't mind. That's going to be different for the company that shows up, because if you're a med tech company, your sales and marketing materials and what you're trying to do is well different than if you are a CPG company. So one of the companies that came through SEC, they were CPG, and their data room, they had a bunch of documentation in there that was showing us how well their brand was put together. That they had a reasonably well designed color scheme and packaging and ways to place this and ways to make sure that their brand was consistently represented across different social medias and those marketing things. And if they ever, part of their plan was to do advertising in specific magazines. And we already have copy for that magazine ready, and we have the color thing, and we can send our Pantone colors over to this magazine when they're ready to print our ads. So that's going to be slick as soon as we get money for marketing in the magazine. None of that is a good answer if you are making, you know, a vaccine for chickens, for example. You need a different set of marketing material, and you need to let everybody know that you understand how things work on a farm, and your marketing team needs to have people on there that have, ranching experience. That's what's, your diligent, your data room, and then what's happening in your diligence process needs to, on that's all the finance stuff. That's the same for like every company. You got to have a bunch of statements. All the companies have that. Boring. The other aspects of the company that make you the unique part of the company, that's going to come out in diligence, and you need to make sure that the parts that really matter are well represented. So we have experts in ranching, and they have a bunch of connections. And if your diligence team wants to talk to a guy who knows our guy, we can find them and you can have that conversation. Our founding CMO has enough clout that their friends of friends of friends in the industry will have a conversation with a potential investor. If your prospective investment company can't find one of their prospective clients who's so excited about them that that prospective client is excited to talk about a prospective investor, like that's lame.
And so we ask you to do provide referral customers, and we go talk to the referral customers, both those that liked you and those that decided not to play. We also ask you to go talk to other people in the ecosystem that might know about you. So there's a lot of, third party validation we're doing around, well, I may not be a doctor, but I know a doctor and I'll ask the doctor about you. If you're a med tech, for example. Um, can you talk a little bit about some of those pathways that you tried that maybe are a little bit different than you expected?
One thing that I think is interesting, right, is when we talk about medtech or CPG, David, I love that example because in the end, you're looking for who your customer is. And with medtech, it was really interesting to me. Some companies focused on who they would eventually be acquired by and what their focuses were, and that's very smart. That's very smart because that's the most likely exit path. And so to build your milestones toward the whatever company is going to acquire you is absolutely what we want to hear. Versus for CPG, right? You are going to be selling directly to a consumer, so you need to know that market, right? That you're going to sell to. So it's to me a lot of things that I see. And they're trying to BS a BSer. I mean, I'm in marketing. I see through um, all the little tricks that you do, right? And one of them is acting like your market is bigger than it is.
Well,
This is
let's dive into that a little bit more. We all see the Sam, Sam, Tam slide. Almost never is it actually useful. And so, what is it that makes one of those actually accurate or at least useful?
Well, it's funny. I'm really glad that you asked that, John, because a lot of people put the Tam Sam Sam as in the whole industry that they're targeting, and that is not the definition. The definition is what is the value of your product within that industry, right? And so to state that very directly on your slide, say you can say what the value of the market is, but then you have to say this is how much the buyer committee spends on products like this within a given year. That is what we're concentrating on, and that's a huge differentiator. And if you define that correctly, I highly recommend just stating that um, this is the value of my product within that market.
Right. So they talk about all of the money spent on equipment for being a tennis player, and all that they're doing is selling shoelaces. But there's all of those other products in there, and what you really want to know is the size of the market for shoelaces, not all of the tennis expenditures in total, right? And having
Right.
a big number that's a false number is not useful, and having a small number that's accurate that gets you to what your business is going to be matters, right? Now,
Absolutely.
how do people actually? I have a new product. There hasn't been one of the things like this before. How do I get to a TAM or a SAM or whatever with that?
Well, that's a really good question. I see that a lot with agentic AI companies, right? They have a product that fits in all industries and all business sizes everywhere. I'm, the Salesforce of whatever. Um, so that's great. I'm very excited for you building that. That's a huge opportunity. Where do you start, right? What, 1,000-mile journey starts with the first step. So and again, this is just research. For the solution that you have, what industry and what type of company feels this pain the most? And who within that company feels that pain most acutely? That is your target market. It is one person within one business. And the more clearly you identify that person, the more clearly that you can connect with them, right? And show empathy for their problem and get their attention and sell. That's really the name of the game.
So David and I
You
run the Seattle Startups Open Coffee every Tuesday morning, like we did this morning. And we often fall into a rhythm around lean startup. And I want to get explicit about how I see lean startup and how it affects this journey. In lean startup, they talk about discovery, validation, creation, and scale. So four steps inside there. And I've mapped that to the first step being customer problem fit. And out of customer problem fit, you can then find a pile of people that all share the same problem. You can then ask that group of people with the problem if your solution solves it in a way that's compelling and measure the difference between the two. And then you take the people that said, yes, that solution works. And then you can measure at what price point those people will jump in. And so you can price and manage that. But one of the outcomes that should come out of that, in my mind, is some very specific understanding of your submarkets. And just because agentic AI can do everything doesn't mean that you get to start everywhere. Somewhere you start somewhere and then you find a bunch of people like that and then you step from that group of people to another group of people, right? And then in my simplistic worldview, those submarkets then become the foundation of your go-to-market strategy, where you now are stepping from small achievable to slightly bigger, more lucrative markets as you go and aim for some big market over there that's too hard to reach now. And rather than the classic answer, I have a project, the project MVP is done, give me lots of money so I can be really big really fast so that I can then do something. That classic VC story is a great way to kill your company in my world, right? So how
Slow
do
is
you,
smooth and smooth is fast.
yeah, so you're a bottom up investor too, right? You care about business fundamentals before you care about growth. And so it turns out that the ACA data and the Angel Resource Institute data suggests that angel investors who invest in business foundations and do the bottom up and investing where the business is actually functional and we're not trying to get really big before our revenue model works, then you get much better returns as an angel investor, like almost 15 times as much. Yeah,
the SAC 25, that first company, that was my first time on the investment side. That
yeah.
company had a solid lane. They're they're doing a way to deliver medicine to creatures. So that's lots of opportunity right there. You can put all kinds of medicine for all kinds of creatures. But they basically had started off with saying we're going to deliver, uh, inoculations for baby hogs, and that was their beachhead to get into, and it made perfect sense. And then on its own could be a perfectly viable business, but you can scale it up once you've got a whole bunch of things. Once you've done a whole bunch of exercise, and now you know how to tread water for 15 minutes instead of just two, they can then do the thing, and they can do different types of medicines for different types of creatures, eventually getting medicines for humans, but on the way there, and perfectly viable business on the way up there. And they didn't start off saying, well, we can do 87 different kinds of medicines for 26 different types of creatures. they said, oh, well, right after Hogs is born, you got to give him these 3 medicines, and we're doing that right now. That's great. The other company we
And
just got an update about, they were doing batteries. All kinds of stuff needs a battery. The TAM for batteries is a very, very big number. And then the SAM for batteries is also a very big number. And then they said, oh, actually, what we're doing is just the deep cycle starter batteries for industrial equipment, which is this incredibly small piece of the battery industry, you know? And they're able to just focus on that. And everybody else who needs a battery, we're not paying attention to you. And then all the way back to Derek had a question. What are the acceptable primary sources for that data? Uh, the best is do your own research. And that's sort of like when you have a battery, who actually cares about the battery and where can you get in there? Because you can do, like lots of researchers, loads and loads and loads of extrapolation from the data set that you get. Ask 80 people about batteries that they need. Well, the only people who are really leaning into what you've got is folks who need a starter for their industrial equipment. So, well, how big is that and how big is that industry? And then you can take the thing you know about who's leaning in and then see how big that bit of the industry is. Who needs industrial starter batteries? Well, Deere and Caterpillar and IH is still around, I think, and the other one.
yeah, so a lot of times people want to do the MBA thing and go, hand wave at a bunch of federal data and get an answer, when in fact that should be the thing that tells you where you should run your experiment. And then your experiment should be you talking to a couple hundred people about that very specific thing and trying to figure out how hard it is to get to that information. And if you as a founder can't get to that information, then we have a problem with founder market fit. And we need to get founder market fit in there somewhere, right? I see Derek has his hand up, so I'm going to bring him up and let him ask a question. Go ahead, Derek.
Hey, thanks. I guess for me specifically, my target market is me. I run salon and spas. And so, um, uh, what I find is a lot of times I get stuck in building the product for myself because that's
Right.
literally why I built it in the first place. Um, uh, is it like prudent then? Should I go to other salons and make sure that it's truly a true overall product market fit, or based
Absolutely.
off of what I am experiencing? I
So
feel
it's
like
it's
other
really
Wait,
people
it's
John.
always really easy to have a market of size one where you build something
Super easy.
custom for that one customer. And that doesn't, if you're building for you, that's one thing. If you're building for a client that's a consulting client, all of that's true. You can really easy build a product that's good for one customer. And so at least try to get 10 where you can knock off the rough edges of the things that are the common things you need, but you want 10 that are all in the same lane. You don't want a tank and a motorcycle and a car all in the same lane, right? You want everything to be similar. So how do you find things that are similar? Well, you have to go talk to
Well,
100 or so, right? David?
Derek has another problem in that
Yes,
he's got something that he's already built. And so it will be
right.
incredibly difficult to go and talk to another salon owner operator and ask them about their problems without mentioning the solution that is working for you. So uh, a previous company I did market research. So when Lipton Tea wants to find out what people think about tea, it is not somebody from the Lipton Tea brand going in and having that conversation. They hire somebody who does not care about tea at all to go and talk to people about tea. And then that way, when the researcher is talking to that prospect and the prospect says, oh, well, am I supposed to think that this tea is too, orange or not orange enough or too sweet? Or then the researcher goes, well, what do you want it to be? Because that's what they're trying to really figure out. So you may need some assistance on that, or ignore your product for a little bit when you're talking to those other salon owners and say, like, you know, you need to find out if they have problem X. Is billing a problem? Is scheduling a problem? You need to find that if that's true, without saying, oh, and I think your answer to your scheduling problem is give me money and use this tool that I've made, right? It's very difficult too because, oh man, building something, you have, whether you know it or not, an emotional attachment to the thing that you have created.
Yeah.
Dave, I think one thing, David, that you just said that really resonated with me, right, is that you don't want to go to the creators, you want to go to the customers. So, Derek, I would go to local salons and look at their reviews. Where are they having issues? What are the customers complaining about? Because that's who you're serving in the end, especially in B2B. It's not your customer, it's their customer, because that's where the revenue comes from. So I would look at their reviews, look at what they're doing, and then go to them and say, hey, I noticed that you might be having an issue with blah, 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 according to your reviews. Let's just share notes, and just gather that. And you said it right in the beginning. You said, should I rely on myself or should I get true market validation? And the fact that you say true, you already know the answer.
There is a thing we talk about in Open Coffee a bunch is a content strategy. And so it may be possible to put something together that's, like an AA type of meeting. And you and a couple of other salon operators, you just invite them to come and hang out. Let's all go down to the local, all it's going to cost you is buying everybody a pint, and then ask them, talk to them. What is it that you feel like is holding you back? How come your chairs aren't full, right? Like, what do you really sell when you have a spa? You sell somebody needs to sit in this chair, whether it's for their feet or for their nails or whatever it is going on. You got to have butts in chairs. What do we got to do to get more butts in chairs? What do we got to do to improve margins with butts in chairs? Or, things along that line. I mean, someone I know who operates a salon, her schedule's full all the time and is, you know, happy about it and has to turn folks away. That's a good spot to be in, right? When you're just a single owner operator, of a what did they call it? Body sugaring, something
Oh
like
yeah. Yeah, waxing
that.
sugar. Yeah.
Sugar, what the heck? But if you run a spot that's got 8 chairs in there, and you need to have all 8 chairs as full as possible most of the time, right?
Yeah.
There's a
Yeah.
mention in here about the mom test. Pretty good.
So
As well.
let me jump down a rabbit hole for a second. So you're doing a good job, Derek, putting your logo behind you. And it's in the right order because, like 20-30% of people don't know that Zoom flips things, but you're right in front of it, so we can't read it. And so you need to move it up into the corner somewhere so that it can work, right? And then if there are things you want us to know, you got the logo on one side and you got the thing you want us to know on the other, that can be really helpful in a pitch, right?
Mm.
If we're doing the zoomy thing that we often do, right? So let me take everybody off of Spotlight here, and let's go to um, a group discussion. See if we can get to some kind of understanding. Does anybody have any questions? If you do, please raise your hand, and we'll start a discussion. And if you would, please turn on your videos. Yes, go ahead, Amdal.
Yeah, that was fast. Anyway, so my question is about customer interview is what if you building a product in a segment where people are extremely slow when it comes to change?
Yeah,
And
so in my mind, you should be
That's
building
everywhere.
something that you can get to cash flow positive quickly, which means that you need to find the subgroup, and typically we call this group the early adopters, who are in enough pain that they're ready to change their behavior. And if you can't sell to the normal person. Startups can never sell to the normal person. They have to sell to the people that are in enough motivation to change their behavior. And that, like 2% of your customer base, but your customer base is like, some small percentage of the total number of people in the world. And so you're going to get a lot of no's that they're not the right people. So you have to set up mechanisms by which you filter down to the early adopters. And in your sales funnel, the first three steps of your sales funnel are content. So you have to create some content mechanism that attracts early adopters and that you create some mechanism to test that they're willing to play, right? And for me, that means pay me a little money to go to the next piece of content.
Yeah, I kind of went through that. We even run some webinar and start getting some folks onboarded. But I will double down on the same question. It's like, what if what you're building is kind of a threat for the profession, like for the user itself? Like,
There's
we
there's no
even
there's no shortage of startups that have been acquired for the purpose of killing the startups so that they don't get the existing people threatened, right? So that happens all the time. So then
yeah.
you have to find a niche that you can go into that is strong enough that it keeps the industry that wants to consume you away. And
All
so
right.
that's part of your go-to-market strategy that you need to think out with some clarity. Yeah.
All right.
Well,
Thank
I
you
would
very much.
also, as part of your customer discovery, just do some interviews and say, what are your biggest pain points? Why don't you change anything? And just get that why. If they're afraid of change, what is it? What pain do they have against change?
So,
Yeah.
uh, one other thing is there's a lot of times where the question is, if I had a magic sauce, would you buy my magic sauce to solve your problem? Which is not really a good question because, of course, I would buy magic sauce to solve my problem. Who wouldn't? And so perhaps ask the question like, what are you doing today, right now, to solve that problem? Let's pick on Derek again. He's got his hand up, so he's asking for it. You're going to find those other salon owners and they're saying, no, I don't have enough butts in my chairs. Well, what are you doing right now to put more butts in those chairs? And that's the question you can ask, where you don't even have to talk about your product. You don't have to talk about your idea of the solution. They're going to tell you what they think the solution looks like by telling you exactly how they bang their head against a wall trying to solve that problem. And then you listen to those 6 or 7 or 10 times, and you start seeing those patterns emerge. Oh, they all keep trying to juice up Yelp. Why do they keep doing that? Where there's an underlying belief why they keep trying to juice up Yelp. So let's explore that some more. And the other side of it is, from the early entrepreneur, hearing that to make a sale, the customer needs to see what we already have.
Mm.
Yes, when you're selling to all of the people that are in the middle of the bell curve, which is what a big company with lots of operating budget does. You are not a big company with a lot of operating budget. You are a small company with one person with $17. So all the way at this very small side of the bell curve over here is the people who will pay a stupid amount of money to solve a very narrowly scoped bit of a problem. And that's who you're finding them. So if you're prospecting and someone says, oh, well, show me the product that you got, put them in the bucket of, I will sell to you when I have a team of 17 people. They're not who you're looking for right now. Don't ditch them, but they're not at the right, they're just not that into you.
Yeah.
Yeah.
Not yet. Derek, you had a thought?
Thank you. Thank you, David.
Um,
Derek,
well,
Yeah.
I have a question. Oh,
Oh, go ahead.
go ahead.
we just lost. Go ahead, Derek.
Oh, okay. Yeah, I had a quick question. So, this is actually for David, and I guess for everybody, but as a deal lead, how do you handle a company already raising on a safe? Does that like hurt you guys or help you guys, or does that
So,
matter?
like, are you copying the Y Combinator post money safe?
Yeah.
and then we'll ask you to have a clause in there so that we can have like some information rights and a most favored nation. Probably want that. Do you have a cap already in mind? We might ask you, if we don't like that number, to change it. If there's a
Okay.
discount that's on there, we would ask about that. If you've already got it set up and there's already people who are subscribed to it right there, it's very likely we would just jump on the same one. And you would know that because somebody else would have signed on, and they would also then take the role of being your lead investor. And so they would draw the lines in the sand. So when you go to present to somebody else, you would say, "Oh, I've got a 8 million cap and a 10% discount. This is my number. Are you in or out?" Because it's going to be problematic if you have safe number 1 and safe number 2 and safe number 3. That's
Gotcha.
it's not
That makes sense.
impossible, but it's less cool.
Right.
Okay.
Well, and it's also very painful for the founder when you give away way more of the company than you thought you did because you can't do the math on the stack safes. And so you want to think about that. But, if you don't have somebody already and you're offering a safe, you're basically turning the conversation. It may be that you're not ready to offer terms and you need to find your lead investor who will negotiate the terms where they think you are best suited to raise the money for the round. And so you have to decide if you're doing a party round where you're not having a lead or whether you're finding a lead investor. And the lead investor can matter a lot because they can help you close the round. So
If
I
you
would be
don't know
careful.
that you need to be on a safe with specific numbers, you can go through the raising money process and figure out if it's a convertible or a safe or a priced round as you get, closer to
Yeah.
getting married.
Okay.
Marilyn had a question too.
Yeah, Marilyn.
Can you hear me okay?
Yep.
Yep.
Okay. Now I have a question about the safe and the convertible note. Is it possible to put a clause in there for an exit strategy for an investor? Is that doable?
What I don't know what you mean.
Like when they put some money into the safe and you want the investor to get his money paid back and he exit, is it possible without the next coming rounds? Is it possible to put a clause in there for him after he gets paid in full 3 times to exit the safe?
Yeah,
Is that
so
possible?
so pos the question of possible is yes, anything's negotiable. This in particular as a methodology is used by a guy named Looney Libs and also by a guy named um, Hall Martin out of 10 Capital in Austin. And the book you should reference is the revenue-based finance pathway by Looney Libs. He wrote a book about how to do exactly that kind of thing. We have used that as a thing in our convertible notes as a mechanism to address the 7% zombies, like a whole bunch of companies succeed, a whole bunch of companies fail, but there's this crack in the middle where people live forever, but they don't ever get the next round of
Right.
funding, so we never get out, and they never stop, so we never get out, and so we can't take the tax write-off on one side, and we can't get money back on the other, and so a revenue buyout would be a pathway to do that. But the first thing your lawyer is going to do is try and take it out. And so you have to be on board with your lawyer when you do that right.
Okay.
There's also the idea of um, if you raise the next round, that the first round of investors get removed from the cap table when the next round happens. That's another option. And then it's not, like John was saying, it's possible. It's just not that common. And then the other option is you would be and could maybe even help out with the process of your investor A who wants to get their money out in 3 years or whatever. You help them find where they could sell their equity position on a secondary type of market. Those do exist, where another angel or seed round or possibly some family office money or something like this is interested in what you're doing, so that that initial investor can exit their position, but it's not the company buying them out. It's another investor who's coming in who wants to, either hold that position or believes that you're going to grow to give them some exit, right? I mean, the whole point of the investing is to get some capital appreciation at some point in time. You have to realize the gains.
You have to look at the capital stack that you're building from where you are now to where you're getting all of your investors out, and whether that's selling the company or going IPO or whatever. And there are many paths to that, some of which work really well at the beginning and others that work better at the end. And so if you never think you're going to be $1 billion company and you will never attract venture capital money, then there's no reason to align your early documents with becoming a venture ready company, right? And so maybe you're going to be a good $50 million company or a good $100 million company. What's a reasonable path to get the investors out of the company? And
Right,
one
right.
one of the pathways that we should name is, instead of going through the Reg D 506B pathway into angel investor and VC, that you go through the Reg A plus pathway. And Reg A plus is a way to go public in a much lighter way than the normal go public mechanism. And so there's several companies that have done that. One of them is Aptera out of San Diego, doing a Reg A plus that then they sold to the public. And then that act of selling to the public then gives the investors that were in earlier the chance to get out if they want to get out.
Okay, that's a long explanation. I think I
Yeah.
follow you, but
So look up Reg A Plus and look up the companies that have done that. And certain kinds of companies can do that well because they have a big audience. And so if you have a big audience, then you can do this is essentially crowdfunding on steroids. You're just doing it in the public markets instead of a crowdfunding market. And so
oh,
there are other options.
okay, good. Now, will it harm me if I just decide to stay private? Will that be okay?
Um, It is possible to do that, but you have to find the path in which the investors get out. And there are multiple ways to do that. But again, it's typically a buyout or a secondary market. And so you have to figure out what those are, right? The problem with secondary markets is they assume going to public markets at some point. And public markets, then you're no longer private. And so if you want to be
Mm.
private, then you're probably doing debt instead of equity. You're probably doing some kind of revenue-based debt mechanism. And there are companies that do that. Um, the one that is most VC-like is called Lighter Capital. They're in Seattle. But there are other revenue models for how to do that kind of thing, where you're doing a debt process instead of an equity process.
Okay.
Other questions from anyone? Any prototypical investors that have investor questions? No? All right. Well, so then I
Just
should
all
say that David is the lead of Seattle Angel Conference 30. He's the one that's going to go negotiate the deal and manage the process. Megan is a participant in SAC 30. And so whoever comes in will see her along the way. We're at the early pre-seed stage. So we're expecting things there to be relatively sloppy. One of the things that we do want to do is to help people get all of their acting together so that they can go to the regular angel groups and be effective. We also try to get new angels to come in so that they can get ready so they can go to other angel groups. So at this point, all of the angel groups in Seattle have our alumni in their program. And so we will continue to run workshops on these channels, both the meetup and the Luma process. If you have questions, please feel free to drop us a note. And thanks for coming. We're going to put the recording of this on the YouTube channel. So I should put the YouTube channel in the chat. David, any last words?
Have none. I think this was great. Thanks everyone for showing up.
So please subscribe to the YouTube channel and we can go there. Thanks very much.
Thank you.